All right, today we are going to talk about debt, always a hot topic. We've got two questions that come up quite a bit, and there's always an argument around this as well. So I'm going to provide a little bit of context to both of these sides, especially question B, and then I'm going to give you my opinion at the end of this video as far as which one I prefer. So question A, should I pay off my debt now and then begin saving, then begin investing, meaning should I be debt-free before I begin to save money? Or question B, should I begin to save now, especially if I can earn a higher return on my savings assets and investments than what it costs me, than what my debt costs me, because I have the ability to pay off the debt anytime I want, but I'm building up a big pile of cash. Now that second part, question B, as I provided that verbal response there, that can be confusing to people sometimes. I'm going to provide an example in this one. And here's what I'll add as well. There is so much back and forth as far as which strategy is better here. And I'll add, from my experience, we can prove either one out with the numbers. It does often come down to a matter of preference. And again, I'm going to give you not only my opinion at the end of this video, but which strategy I see more high performers use. When I say high performers, people that do very well from a financial standpoint and also have a lot less stress in their lives. So let's look at B here, because this is the question that everyone sees or hears and says, okay, explain this to me more. What does it mean if you say I should not pay off my debt, but instead I should save money elsewhere so I have the ability to pay my debt off later? This comes up quite a bit. So let's assume a $500,000 mortgage. We're just going to use a mortgage in this example, keep it simple. In future videos, we might do more. You have a 15-year mortgage that will cost you 2.25%, and that comes out to an annualized payment of just under $40,000 per year, $39,300. Or you could go with the 30-year option at 3.25%, which would cost you approximately $26,000 per year. Let's see exactly where I got those numbers from. So if I plug in a loan here, $500,000, let's go 15 years first. The interest we plugged in was 2.25%. For 15 years, we've got the pay down, but here's what I want to look at right here. That payment of $32.75. So what we can do, take the $32.75 times 12. That's where I came up with the $39,300. So not including any taxes or anything like that, the tax deductions, which do have an impact in this type of situation, but we're just going to keep it as simple as possible to provide a little concept here. And the second option we had was what? Same $500,000, but 30 years at 3.25%. There we go. 30 years. And that comes out to what? $21.76. So if we do the same thing here, just to validate the numbers, $26,100. So I just rounded down to 26,000. When we go back to the whiteboard, you'll see that to keep it simple. So if I go with a this is a 30-year mortgage. What I'm doing is stretching the payments out over a longer period of time, paying a little bit more interest. It's actually a lot more interest to the bank or to the lender in this case. But what it allows me to do is save a bit more cash flow. So for example, if I go back here, I've got a difference, if I subtract those two, of about $13,300 per year. So often what we'll see, I'm going to illustrate this for you as well, is I've got the option between the two. If someone is making a case for point B, the argument is, well, you're going to pay $39,300 with the 15-year mortgage. So let's do this. Let's go with the 30. You'll allocate about $26,000 per year toward your mortgage. You have a difference of $13,300 per year. So your cash flow is still going to be the same $39,300, but the difference, $26,000 toward the mortgage, the other $13,300 towards savings. And really, I'm taking that cash flow and allocating it toward a different account. This is the argument here. So if we go back to our calculator here, here's what we want to look at. So this is the 30-year mortgage. Let's do it this way. Here's what we want to look at. At year 15, I have a year-end balance, so end of the year, just about $310,000. Okay, so the question here in order to support the case for question B, if I'm taking that $13,300 and saving that for 15 years, what return would I need to earn in order to have $310,000? Meaning if I wanted to pay off my debt in 15 years anyway, I could do so. So to answer that question, it's a little bit north of 5%. So how do you crunch that? Take the 13.3, 15 years. If I plug in 5%, I've got a little under 310, so I need to go a little bit higher than that actually. Maybe around 5.4. Ooh, just overshot it there. There you go. About 5.3, 5.35, the 15-year average annual return in order to be able to pay off that debt. So can I do that in a safe asset is the question. And the answer is maybe. Always depends on the situation. But let's go back to our whiteboard here. So we kind of just touched on that. Can pay off the debt in 15 years if I wanted to by saving the money elsewhere. The difference is by going with the 30 year, we've now taken that 13.3 and saved a big pile of money. So at the end of 15 years, would you rather have a home that's fully paid off, or would you rather have a balance still on your property, but a big pile of cash of about $300,000 that you'll have access to, and you could pay off the cash anytime if you wanted to? That's the emotional piece right there. And I mean, more than emotion, you've got the numbers there. So you can leverage debt to some degree in that respect. Here's the thing though. On the other side, you'll argue, well, if you go with the 15-year mortgage, I'm paying $39,300, and if I can take any additional cash flow and throw it at the mortgage as well, pay it down, I'll save myself even more interest. And then once I'm debt-free, then I can take everything and just hyperfund whatever assets I'm going to save money toward. And that piece, we can do a whole piece on that as far as paying a mortgage down quicker and seeing how much interest I'm going to save. There's a lot of calculators out there if you look at the velocity banking world. So I'm not going to do that today. But with that said, so I wanted to provide more context to question B, because this is the one that often needs to be supported. My opinion, or my preference, I should say, which one I like more, is this guy. The main reason why is once you're debt-free, you've got no negative cash flow. My cash flow doesn't need to go toward anything, and I can do one thing: save money, continue to use that money for my business, whatever it might be, but I have zero drag in respect to my finances. That's why I like this. And I've also seen high performers, meaning individuals that do very well from a financial standpoint, are typically debt-free first. They're very disciplined. They say, hey, I love these different assets. I love the idea of a cash value life insurance that we go over, or policy that we go over with them. But their preference, and from a peace of mind standpoint, they say, I want to pay off the debt. And when you actually crunch the numbers, those look even better often if you're going to pay that off first in respect to how much interest you'll save. In fact, what you could go to, my good friend, Dr. Ace's website, and you'll see he's got calculators that actually prove this out, because he is on the one side of the fence of paying debt off first, puts you in a better position. And I agree, one, from a number standpoint, depending on how you want to prove it out, but two, is really an emotional factor, peace of mind. Pay that debt off first. Now you've got no drag on your finances. And what I've really noticed is most people that do this first have a lot less stress in their lives and can just move at a faster pace rather than trying all of these leverage strategies. And nothing wrong with it either. We work with a ton of people that elect option B, but it depends on the individual. So what I would encourage one to do is look at the numbers on both. If you're on the fence saying, hey, I'm not sure which direction I should go, I'd like to see both options, that's what you want to do, really, rather than listen to someone that says, hey, go all in with one or the other. Look at both options and then make a determination for yourself. Like, that's the big thing at the end of the day. So I hope this video has been helpful. If you liked it, please hit the like button, subscribe for more. We would love to connect with you. Debt strategies, are not our expertise by any means. This just comes from experience. Cash value life insurance is our expertise, but in any event, I hope this helps. We'll talk to you soon. Hey guys, Steve Parisi here. If you enjoyed the content you just saw, please subscribe, like, and hit the notification bell for future videos. If you'd like more information or to see some custom policies for yourself, feel free to call or email our offices at the contact information below.